So you are currently holding 200 shares of Amazon.
Right.
And you bought in at a cost basis of $227. The market is bleeding, and you are officially underwater.
Yeah, it's not a great feeling. And the typical advice you see floating around retail trading forums right now, it's basically, set a hard stop loss, protect your capital, and just walk away.
Right. Cut your losses. But today, we are going to look at the actual mechanical plumbing of the market to show you why doing that might be like the absolute worst decision you can make.
Exactly. I mean, both for your portfolio structure and honestly for your tax liabilities too.
Because it's the classic trap, right?
Yeah.
Applying retail panic button logic to a portfolio that really should be operating on institutional grade mechanics.
Yeah, and given the specific context of the market we're looking at today, those mechanics are under extreme stress.
Which is exactly why we are tailoring this specific deep dive for a very particular listener. And you know who you are. You work at Google, you're a CFA candidate, and you already speak the native language of high-level fundamental analysis.
Right. You don't need us to explain what a PE ratio is or, how a basic income statement works. We are here to talk about actual application.
Because it's early May 2026, and the tech sector is just dealing with severe whiplash.
Oh, absolutely. The latest earnings season just ripped through the market, and the whole AI infrastructure landscape is violently repricing itself.
Yeah. I mean, we are looking at a board right now where Amazon ticker AMZN has slid from your entry at $227 down to the $210 range. You're down about 7.5%. Meanwhile, Microsoft has plunged from $450 down into the 390s. NVIDIA is experiencing these violent, erratic swings around the $177 level. And, well, your own employer, Alphabet, is caught in the crossfire, too.
Yeah, so the mission today is to really fuse your rigorous CFA training with Wall Street's gritty, highly technical realities.
We're pulling from a massive stack of structural market notes for this deep dive.
Exactly. To decode the actual psychology of stock charts, unpack the hidden accounting maneuvers, inflating tech cash flows, and formulate a definitive, unemotional battle plan for your Amazon position.
Right, because fundamental analysis tells you what a company is theoretically worth in a vacuum.
But technical analysis, the actual structural mechanics of order flow and market psychology, that tells you when and how the broader market will actually agree with your thesis.
You really cannot trade one without understanding the other.
No, you can't.
So, okay, let's unpack this. Let's start with the charts. Because as someone deep in the CFA curriculum, it is incredibly easy to look at a technical chart, see a quote-unquote support level, and just dismiss it as astrology for day traders.
Oh, yeah, the whole voodoo lines on a chart thing.
Exactly. You're trained to look for intrinsic value, not arbitrary horizontal lines drawn across a candlestick chart.
Right, but dismissing technicals as voodoo is a dangerous and honestly very expensive misconception. A support level is not some physical law of the universe, nor is it magic. Is a visual representation of a temporary consensus of group psychology.
Driven entirely by real capital deployment.
Exactly. When we drill down into a support level, we are actually looking at the intersection of two very powerful human emotions operating at scale: regret and greed.
Okay, so if a resistance level represents the sheer pain of trapped investors who just want to break even and get out, then a support level has to be the inverse, right?
Right.
It's the desperate desire of capital sitting on the sidelines waiting for an entry point.
Yeah, and we can dissect that psychological floor by identifying three distinct actors who are playing a massive game of financial chicken at that exact price point.
Okay, walk me through the actors.
So the first group provides the initial violent upward momentum. We can call them the ticket buyers.
The ticket buyers.
Yeah, these are the investors who entirely missed the initial rally.
Right. So applying this to the NVIDIA volatility we were seeing at $177. Let's say a fund manager was watching NVIDIA consolidate around $120 for months. They ran their models, they hesitated on the trigger, and suddenly the stock just rips to $140.
Oh man, the FOMO. The fear of missing out becomes an agonizing career risk for them at that point.
Yeah, they are sitting on undeployed cash while their benchmark index just rockets past them.
So the internal narrative shifts. They literally tell their trading desk, hey, if this asset ever pulls back to $120, we are not missing the boat a second time. We are backing up the truck.
So the moment the broader market takes a hit and NVIDIA actually does dip back to $120, you have this massive wave of regret-fueled buy orders hitting the tape all at once.
Exactly. That sudden influx of capital catches the falling knife. That forms the initial bounce.
Okay, that makes sense.
But the ticket buyers alone aren't enough to build a solid support floor. You need the second group, which is the doublers.
Wait, if the regretful buyers are catching the knife, the doublers have to be the people who already hold the asset, right?
Yeah.
Like, if I bought NVIDIA at $120, wrote it to $140, and felt like an absolute genius,
Yeah.
I'm not panic selling when it pulls back to $120.
No, because your original investment thesis was validated by that initial run-up, your conviction is high.
My conviction is at an absolute peak because I already have proof of concept. I don't view the return to $120 as a broken trend.
Right, you view it as a momentary promotion, a discount. So existing shareholders deploy the reserve capital to average into their winning position. They double down. Now you have sidelined cash and existing shareholder cash buying at the exact same level.
Which leaves the third group. And if we have the regretful buyers and the confident holders, the third group has to be the trapped bears, the short sellers.
Exactly. Consider the psychological state of a trader who shorted NVIDIA at $120. They took a bearish position, fully expecting the stock to crack $100.
Right.
But instead, it rips to $140. For the entire duration of that rally, they are just bleeding margin.
Oh, yeah.
They are underwater, paying borrowing fees, and staring at literally uncapped liability.
They're essentially held hostage by the rally, just praying for a macro pullback to bail them out.
So when the market finally rotates and the price wanders back down to their original entry point of $120, they aren't looking to write it down to $100 anymore. The psychological fatigue is way too high. They are desperate to close the position and escape with their lives at break-even.
And the only physical way to close a short position is to buy the underlying stock.
Which means at that highly specific $120 level, you have a rare accidental alliance.
Wow. Yeah.
You have the ticket buyers buying to get in, the doublers buying to add on, and the short sellers forced to buy just to get out.
It is a massive multi-faction confluence of psychological buying pressure.
That is the exact anatomy of a support level.
Okay, I follow the logic for retail psychology and, like, even human hedge fund managers dealing with career risk. But let me push back on this a little bit.
Sure, go for it.
You and I know that human beings aren't the ones manually clicking buy for 80% of the market's daily volume.
Right.
As a CFA, I'm trained to analyze intrinsic value. I've always conceptualized this using the dog walker analogy. You know, intrinsic value is the dog and market price is the dog walker.
I love that analogy.
Right. The dog knows exactly where it's going. It's walking home to its true valuation. But the dog walker is all over the sidewalk, getting distracted, overreacting to noise, just zigzagging around.
Yeah.
So do the massive, sophisticated quantitative institutions actually care about the dog walker's random zigzag path? Do they actually care about a line on a chart like the 200-day moving average?
They don't just care about it, they architect it.
Wait, really?
Yeah.
Right.
The idea that institutional algorithmic trading just ignores classic technical analysis is completely backwards. Those algorithms are programmed by humans who understand market microstructure.
Okay.
They literally code the collision points from classic technical analysis directly into their high-frequency trading servers.
So a 200-day moving average isn't just a psychological feeling. It's a hard-coded if-then execution script sitting on a server rack in New Jersey somewhere.
Exactly. The script simply says, if the price deviates down to the 200-day moving average and relative volume spikes 20% above the rolling average, execute a block purchase. And when thousands of different institutional algorithms are running variations of that exact same conditional logic, the 200-day moving average ceases to be an imaginary line on a screen.
It transforms into a physical collision point in the order book.
It's a self-fulfilling prophecy enforced by raw computing power.
That is wild.
But there's an even deeper structural reason institutions use these levels. It comes down to the mechanics of liquidity.
Okay, how so?
Well, if a major fund needs to acquire 2 million shares of a tech giant, they cannot execute that as a single market order.
Right, they would clear out the entire ask side of the order book.
Yeah, they'd spike the price vertically and ruin their own average cost basis. They would trigger a massive slippage penalty against themselves.
So they have to find a dark pool of liquidity or they have to operate in these highly visible battlegrounds.
Exactly. They need a price level where millions of shares are organically changing hands, where the retail panic sellers are dumping and the short sellers are covering.
So because everyone is staring at the 200-day moving average, it naturally becomes a heavily populated arena.
A liquidity sponge, basically. Institutions utilize these psychological support levels because that is where the transactional friction is thick enough to absorb their massive multi-million share orders without instantly moving the ticker tape.
That makes perfect sense. The fundamental analysts at the firm figure out the what based on the dog's destination, but the execution traders rely on the technical chart to figure out the when and the where based on the dog walker's current location.
Exactly.
Okay, so taking this structural framework and applying it to your specific situation with Amazon requires us to look at the immediate board.
Right.
You are holding it at $227 cost basis. The stock is currently trading around $210. The widely watched psychological round number support level is sitting down at $200.
And analyzing this setup introduces a vital technical principle called role reversal. Yeah. We just mapped out how a support floor is built. But we have to ask what happens to your original $227 entry point now that the asset price has decisively broken below it.
Yesterday's floor becomes tomorrow's ceiling.
Mm-hmm.
The $227 level is now a massive, heavy resistance wall.
Because it is literally infected with break-vinitis.
Break-vinitis, I like that.
Think about the aggregate volume of investors who acquired shares at $227 right alongside you, perhaps late to the AI rally. They have watched their position bleed down to $210.
Mm-hmm.
They are sitting on unrealized losses, experiencing daily portfolio drag.
Right, so if a macro headline suddenly spokes Amazon back up to $227, those investors aren't looking at it as a breakout.
No.
They are looking at it as a miraculous escape hatch. They will slam the ask button just to clear the mental real estate and get their original capital back.
Exactly. That psychological urge to become whole again creates an immense wall of localized selling pressure. So for you need to recognize that recovering above $227 is going to require a massive catalyst to chew through all those trapped sellers. That is the ceiling. Now, we must evaluate the floor at $200.
And to really see the floor, we can't just look at a standard candlestick chart. We had to flip the axis and look at the volume profile.
Right.
Instead of showing volume over a period of time on the bottom axis, a volume profile shows how many actual shares traded hands at specific price nodes on the vertical y-axis.
It visualizes the historical institutional trenches, and when you pull the volume profile data for Amazon right now, there is a massive prominent bulge between the $195 and $202 price range. It is a high volume node.
I always conceptualize a high volume node as a giant, dense sponge sitting on the chart.
The sponge analogy perfectly captures the market mechanics. That bulge represents months of historical consolidation.
Right.
It is a zone where buyers and sellers previously waged a massive tug of war. Millions of shares changed hands in that specific $7 window.
So if the current selling pressure drives the price from $210 down into that $200 level, it hits the sponge. All those historical institutional limit orders, the algorithmic triggers waiting at the round number, they begin to absorb the incoming sell orders.
Yes. The descent loses its velocity. The sponge creates immediate transactional friction.
Okay, that's good news.
However, and this is crucial, looking at the floor requires you to look beneath it as well.
Oh.
If you examine the Amazon volume profile directly below that $200 level, specifically the range between $200 and $185, the profile is incredibly thin. It is a low volume area.
Meaning historically, the stock never spent time consolidating there. It just gapped right through it during a previous rally.
Which means there is no historical memory in that zone. There are no trapped buyers waiting to average down, and no institutions defending a previous accumulation zone.
So if the macro selling pressure is aggressive enough to fully saturate the $200 sponge-like, if the high volume node breaks, the price action enters a vacuum.
And in a vacuum, with no buyers providing friction, the price can free fall violently and rapidly down to the next historical support node, which sits around $185.
Wow, okay. This structural reality forces a critical decision regarding risk management. You explicitly noted that if Amazon drops to $200, you would not panic. You view it as a discount to acquire more shares.
Which is the exact inverse of retail loss aversion. It is the CFA training overriding the emotional lizard brain.
Yeah, you don't see a collapsing ticker. You see a reduction in the premium paid for future cash flows.
It is the correct analytical mindset. But the execution of that mindset is where retail traders often self-destruct.
How so?
Well, if you want to acquire more shares at $200, but you know there is a structural vacuum waiting below it down to $185, how do you deploy your capital? And more pressingly, what do you do with your existing 200 share?
Right, because the default retail instinct is to protect the current position with a hard automatic stop-loss order right at $200.
And I'll argue that for a blue chip mega cap tech holding like Amazon or Microsoft, utilizing a hard stop loss is an incredibly flawed strategy.
Why?
It exposes you to catastrophic whipsaw risk, particularly in the current environment where earnings reports are generating massive overnight gaps.
Okay, let's walk through the actual mechanics of a hard stop-loss failure.
Sure. You place a stop order at $200 for your existing 200 shares. The market closes at $205. After the bell, Amazon releases an earnings report.
Okay.
The algorithms instantly scrape the press release, misinterpret a forward-looking capex projection, and the after-hours market violently reprices the stock.
So the next morning, the opening bell rings, and Amazon opens with a massive gap down, trading at $180.
Right, and your $200 stop loss does not magically execute while the market is closed. A stop loss simply converts into a market order the second the underlying asset trades at or below your trigger price.
Oh, brutal. So at 9:30 a.m., your broker sees the stock at $180, triggers your stop, and aggressively dumps your 200 shares into the open market at $180.
You take the absolute maximum punishment, and the worst part is the intraday reversal.
Of course.
By 11 a.m., the human institutional analysts read the actual earnings transcript, realized the capex spend is actually highly accretive to future AWS margins, and the stock violently rips back up to $210.
So you were mechanically washed out at the exact bottom of a liquidity vacuum. You locked in a severe realized loss, you no longer hold the asset, and you totally missed the recovery.
Exactly. Furthermore, you have completely interrupted the compounding process within a taxable brokerage account.
Okay, so if a hard stop is a mechanical trap, the standard alternative is to purchase insurance. You buy a protective put option.
Right, that's the theory.
If I hold 200 shares, I buy 2 put contracts at a $200 strike price. If the stock crashes to $180, my put options skyrocket in value, offsetting my equity losses. It seems like the responsible hedged approach.
It sounds responsible until you collide with the United States tax code.
Wait, really?
This is a vital reality check for you. You are a Google employee, meaning you are almost certainly in a highly punitive income tax bracket.
Yeah.
You hold a $227 cost basis, indicating you acquired these shares relatively recently during the late-stage AI rally. You have held the asset for less than 1 year.
Meaning the position is currently classified under short-term capital gains.
Right.
If you sell now, any profit or any future profit is taxed as ordinary income, which could be nearly 40% or 50%, depending on state taxes.
Right.
The entire goal of holding is to cross that 365-day threshold to unlock the massive tax discount of long-term capital gains.
Exactly. And if you buy a protective put option on a stock you have held for less than a year, you trigger the IRS straddle rule under Section 1092 of the tax code.
The straddle rule. So the IRS doesn't view you as a prudent investor buying insurance. They view you as engineering a risk-free tax arbitrage.
Bingo. By holding the stock long and the put option short, you have created an offsetting position. You have effectively eliminated your downside risk. The IRS dictates that you cannot accrue holding period time toward a long-term capital gains tax break while simultaneously carrying zero risk.
Wait, so if I've held Amazon for 10 months and I get nervous about an upcoming macroeconomic CPI print and buy a 1-month protective put, the IRS pauses my 10-month clock.
It is drastically worse than a pause.
What do you mean?
If you establish a straddle while the underlying equity is still in short-term status, your holding period is completely eradicated. It is reset to day 0.
Wait, are you serious? If I hold for 11 months, buy a put for protection for 1 single week, and then sell the put, those 11 months are just gone.
Wiped clean.
Oh my God.
The moment you dispose of the put option, the clock on your Amazon shares starts over at day 1. You have entirely destroyed your structural tax strategy for the sake of short-term emotional comfort.
It is a massive hidden penalty. Okay, so buying protective puts nukes our tax strategy.
Yeah.
But honestly, beyond the taxes, buying puts during a market panic is mathematically terrible anyway.
Very true.
We know that implied volatility of the IV explodes when the market drops. But I've always found it fascinating that extreme implied volatility is actually a leading indicator of a market bottom.
Yeah.
If IV represents sheer terror, why does maximum terror signal that the crash is over?
Because of the structural mechanics of the options market. Let's map this against the recent NVIDIA drop from $212 down to $177.
Okay.
As the stock free falls, panic sets in. Retail traders on margin, over-leveraged funds, they all scrambled to buy put options to stop the bleeding.
And implied volatility is simply the premium priced into the option contract.
Right.
Like when a hurricane is a mile offshore, the cost of flood insurance skyrockets.
Mm.
If you look at the IV percentile for NVIDIA around that $177 level, it was sitting between 80% and 90%.
Meaning that for 80% to 90% of the past trading year, options were cheaper than they were at that exact moment. When 4V hits those extreme upper percentiles, you are witnessing absolute capitulation. The buyers of these puts are no longer calculating standard deviations or Greeks. They're just blindly paying whatever absurd premium the market demands to make the pain stop.
But the capitulation has a finite fuel source, right?
Precisely. Once the insurance premiums reach astronomical levels, everyone who is terrified enough and liquid enough to buy insurance has already bought it.
Right.
The pool of marginal panic buyers is completely exhausted. The fire basically runs out of oxygen.
But the real catalyst for the reversal isn't just the buyers stopping. It's the mechanics of the entities who sold them those puts. The market makers.
Exactly. Market makers exist to provide liquidity, not to take directional bets against the market. If a massive investment bank sells you a put option, legally obligating themselves to buy your collapsing stock at a fixed price, they take on immense downside risk. They are required to neutralize that risk immediately.
They delta hedge.
Yes.
If they sell a put, they synthetically short the underlying stock to balance their books.
And as the panic accelerates and more puts are bought, the market makers are forced to aggressively short millions of shares of the underlying stock into the open market to maintain their hedge.
So this mechanical shorting actually accelerates the velocity of the crash.
It does. But the second the panic exhausts itself, the moment the retail traders stop buying those overpriced puts, the implied volatility stops expanding.
The hurricane downgrades to a tropical storm.
Right. And what happens to the insurance premium? It implodes. This is the IV crop.
The 5E crush.
The traders who panic bought the puts realize the stock isn't going to zero, and their options are rapidly losing premium value. So they rush to sell their puts back to the market to salvage whatever capital they can.
And when the retail traders sell their puts back, the market makers no longer hold the downside risk. Their books are suddenly unbalanced in the other direction.
So they must immediately unwind their hedges.
And how do you unwind millions of shares of short positions? You buy the stock back.
Exactly. You get a violent, forced buying wave from institutional algorithms unwinding delta hedges.
That mechanical unwinding is what triggers the classic V-shaped recovery right off a market bottom. That is why extreme implied volatility is the ultimate contrarian buy signal.
Spot on.
Bringing this entire mechanical framework back to your Amazon position. We know the $200 level is a massive volume sponge.
Right.
We know hard stops invite whipsaw execution. We know buying protective puts destroys your tax holding period. And we know you actually want to acquire more shares at $200.
Therefore, the optimal structural maneuver is to operate as the insurance company.
Oh, I love this.
Instead of placing a static limit order at $200 to buy shares, you should sell a cash-secured put with a $200 strike price.
By selling the put, you are the one collecting that massively bloated, panic-driven implied volatility premium in cash right up front.
Let's run the execution. The stock drops toward $200, IV spikes, and you sell the $200 strike put. You collect, say, a $5 per share premium. You instantly put $500 in cash into your account.
Okay, I'm with you.
From there, only two outcomes exist at expiration. Outcome A, the sponge holds, the capitulation trade unwinds, and Amazon bounces back to $210. The put option expires completely worthless.
And you keep the $500 free and clear. That cash effectively subsidizes the unrealized losses on your original $227 tax lot, lowering your total portfolio break-even without having to actually buy more equity.
Right. And outcome B, the selling pressure breaks the sponge, and Amazon drops into the vacuum, settling at $195. Because you sold the put, you are contractually obligated to purchase 100 shares at $200.
But you explicitly stated you wanted to deploy capital at $200 anyway.
Exactly.
And because you already collected $5 in upfront premium, your actual net cost basis on those newly acquired shares is $195.
Right.
You bought the dip at a mechanical discount, and you got paid to wait for the execution.
And most importantly, for a CFA candidate monitoring their tax drag, selling a put option to acquire new shares does not trigger the IRS straddle rule on your existing position.
Amazing.
The holding period clock on your original 200 shares continues to tick uninterrupted toward long-term capital gains status.
That is how you use options mechanics to force the market to pay you for your own fundamental thesis.
Right.
But Yeah, if fundamental valuation is a mirage, then catching that falling knife at $200 isn't value investing. It's just a gamble.
Sure.
So let's stress test the fundamentals. Are these AI infrastructure companies actually worth owning at these prices?
Let's look at Microsoft.
Okay, Microsoft. It has bled down from $450 to the 390s. Its forward price to earnings ratio is sitting around 24x to 25x. The market is screaming that it's on sale. Is it actually cheap?
Well, a retail trader looks at a PE chart from last year, sees that it used to be 35x, and just assumes 25x is a bargain.
Right.
But a CFA candidate does not look at PE in a vacuum. You must price the equity against the risk-free alternative. You have to utilize the Fed model.
The Fed model strips away the noise by comparing the earnings yield of a specific stock directly to the yield of the 10-year U.S. Treasury bond.
And earnings yield is simply the inverse of the PE ratio, E divided by P. If Microsoft is trading at a forward PE of 25x, you divide 1 by 25. That gives you an earnings yield of exactly 4%. Let's assume some minor forward growth and call it 4.1%.
So if I deploy my capital into Microsoft, my theoretical rate of return, based strictly on the profits the company generates for my shares, is 4.1%.
Now overlay the risk-free rate. In early May 2026, the 10-year Treasury yield is hovering around 4.2%.
Wait, this is where the valuation reality check hits.
Yeah.
You are telling me I can lend my capital to the United States government, take on zero default risk, zero volatility risk, and guarantee myself a 4.2% yield.
Right.
Or I can buy Microsoft equity, expose myself to earnings caps, macroeconomic shocks, and sector rotation, all for an earnings yield of 4.1%.
You are taking on massive equity risk for a negative premium.
Microsoft is pricing like a speeding sports car on a wet road with absolutely zero margin for error. Why would any institutional asset manager allocate capital into a negative spread?
Because the equity risk premium, the extra yield you demand for taking on stock market volatility, is currently negative for Microsoft on a static basis.
Okay.
The only mathematical justification for an institution to accept that negative spread is an absolute certainty of explosive compounded future growth. The current $390 valuation relies entirely on Microsoft's Azure cloud and AI integrations delivering hypergrowth to rapidly expand the E in the PE ratio.
So if that Azure growth rate misses by even 50 basis points.
The valuation thesis shatters and the stock is brutally punished.
Wow.
However, the exact same Fed model allows us to calculate where the absolute mathematical iron bottom for Microsoft is actually located.
Where does the math force the institutions to buy?
We just run the equation backwards. At what price does Microsoft's earnings yield definitively cross above the 4.2% risk-free rate, providing an acceptable equity risk premium?
Okay.
If Microsoft falls to $350, its PE ratio compresses to 21.6x. If you calculate the earnings yield on a 21.6x PE, it equals 4.76%.
And 4.76% provides a clear, undeniable spread over the 4.2% Treasury yield.
At $350, the math flips. Massive institutional value funds, sovereign wealth portfolios, and crucially, Microsoft's own internal share buyback program will aggressively deploy capital.
Because the asset becomes fundamentally cheap relative to bonds, even if you model zero hypergrowth.
Exactly. That 4.76% yield threshold is the iron bottom.
So if 21.6x PE is the magic threshold for value, we need to look at Alphabet. GoGL is currently trading at a forward PE of roughly 21x.
Which means Alphabet is the definitive value play of the mega cap tech sector. Its earnings yield is already sitting at that 4.76% level, offering a 0.81% positive spread over risk-free bonds today.
So why is Google trading at a massive fundamental discount while Microsoft commands a hypergrowth premium? I mean, they are both deploying identical AI infrastructure.
Because the market is pricing in a severe regulatory and existential discount on Google.
Right.
The DOJ antitrust lawsuits regarding their search monopoly, combined with the fear that conversational AI chatbots will cannibalize traditional high-margin search traffic.
Google is cheap because the narrative is clouded with risk. Microsoft is expensive because the market has prematurely crowned them the victor of the AI arms race.
Exactly.
Okay, so if Microsoft at 25x is expensive and Google at 21x is cheap, what about Amazon? Amazon's PE ratio is notoriously volatile, frequently hovering in the 30s, 40s, or even higher.
Oh, yeah.
If we strictly apply the Fed model, Amazon looks like a mathematically toxic investment.
And this is exactly where the CFA curriculum separates the rigorous analyst from the headline readers.
How so?
Judging Amazon by its price-to-earnings ratio is using the wrong diagnostic equipment. Net income, the E in PE, is an accounting fiction warped by non-cash charges.
Right.
To value Amazon, you must completely discard PE and look exclusively at POCF, price to operating cash flow.
Because you're sitting for the CFA, you already know that net income is heavily distorted by accrual accounting principles under U.S. GAAP. But we need to look at the absolute sheer scale of how that distortion applies to Amazon right now.
We have to utilize the indirect method on the cash flow statement. The indirect method starts at the bottom of the income statement with that artificially suppressed net income figure and systematically adds back all the non-cash expenses to reveal the actual liquidity generated by the operations.
The single largest distortion for Amazon right now is depreciation and amortization.
Massively so.
Amazon is in the middle of an unprecedented infrastructure build-out. We are looking at estimated capital expenditures CapEx of roughly $200 billion for 2026 alone, entirely focused on AI data centers, custom silicon, and NVIDIA GPUs.
$200 billion.
Yeah.
When Amazon purchases a billion-dollar cluster of servers, that $1 billion does not immediately wipe out their net income for the quarter. That hardware is capitalized on the balance sheet as an asset.
Right.
Then, over its useful life, say 4 to 5 years, the accountants take a massive depreciation charge against Amazon's profits every single quarter.
And the depreciation charge crushes the net income line, driving the PE ratio up to 40x.
Yep.
But here's the structural reality. Depreciation is a phantom expense. No actual cash left the corporate treasury this year to pay for that depreciation. The cash already left when they initially bought the servers.
Exactly. So when calculating operating cash flow, the accountants take that heavily penalized net income and forcefully add back the billions in depreciation. The same logic applies to their second massive distortion, stock-based compensation.
If Amazon pays its AWS engineers $10 billion in restricted stock units instead of cash, that $10 billion is recorded as a payroll expense on the income statement, further obliterating net income.
But again, no cash exited the bank accounts.
Right.
The dilution is real, but the liquidity remains entirely intact. So the $10 billion in stock-based compensation is added back. When you strip away these massive accounting illusions, Amazon's actual cash-generating engine is revealed.
While their net income looks pedestrian, their operating cash flow over the trailing 12 months is an absolute monster. It sits at a staggering $139.5 billion.
If we run the valuation multiple against the actual cash entering the business, at a share price of $210, Amazon's POCF ratio is only 16.1x.
Wow, 16.1x. Microsoft is at 24x. Google is at 21x.
When you measure the fundamental reality of liquidity, Amazon is vastly cheaper than its peers. A 16.1x operating cash flow multiple translates to a cash yield of roughly 6.2%.
6.2%.
Yeah. That 6.2% utterly dominates the 4.2% treasury yield. It provides a massive structural margin of safety that the PE ratio completely obscures.
This is the difference between reading a textbook and tearing apart a 10K.
Exactly.
But since we are fusing this with the CFA curriculum, let's address the alphabet soup of cash flow metrics. Because terms get blended constantly. We just isolated operating cash flow, OCF. But the financial media constantly talks about FCF, free cash flow. And formal valuation models require FCFF, free cash flow to the firm, or FCFE, free cash flow to equity.
Right. The distinctions are vital for accurate discounted cash flow modeling. Let's start with the colloquial FCF you see in press releases. That is simply operating cash flow minus capital expenditures, OCF minus CapEx.
It's the rough, back-of-the-napkin estimate the cash generated by the business, minus the cash required to maintain or expand the physical infrastructure.
It is useful for a quick glance, but it is fundamentally flawed for rigorous modeling.
Why?
If you are building a formal DCF to find intrinsic value, you must use FCFF free cash flow to the firm. This represents the total pool of cash available to all providers of capital, both the equity shareholders and the corporate bondholders.
So if I'm looking at the cash flow statement, GAAP rules dictate that operating cash flow has already had the company's interest payments deducted from it. Interest is treated as an operating expense.
Yes, and that is the critical adjustment. Because FCFF measures the cash available to the entire firm before any capital providers are paid, you cannot penalize the operational cash flow just because the CFO chose to finance the company with debt rather than equity.
So to build FCFF, I take OCF, I subtract the CapEx, but then I have to physically add the interest expense back into the pool.
Right.
But I can't just add the gross interest, because that interest payment provided a tax deduction. I have to add back the after-tax interest expense. OCF plus interest multiplied by 1 minus the tax rate minus CapEx.
That is the precise formula for the firm. Now, what if you only care about the cash available specifically to the shareholders? That requires FCFE free cash flow to equity.
Okay, if I only care about the equity holders, I start with the basic FCF OCF minus CapEx. But I have to account for the fact that the company might be manipulating its debt load. Like if Amazon issues $10 billion in new corporate bonds to fund their data centers, that $10 billion didn't come out of the shareholders' pockets. It came from Wall Street debt markets.
Therefore, it actually preserves the cash available to the equity holders for that specific period.
So for FCFE, the formula is OCF minus CapEx plus net borrowing.
Precisely. Understanding how the capital structure alters the cash flow is paramount. But stepping back to that massive $139.5 billion operating cash flow figure for Amazon, we have to look at how they actually generate that liquidity. It is not just about profit margins on cloud computing. It is heavily driven by how they manipulate their working capital.
Which brings us to the operational reality of the bully metric, the cash conversion cycle, or CCC.
Yeah.
This metric tracks the exact number of days it takes a company to convert its investments in inventory and resources back into cash from sales.
The formula is days inventory outstanding DIO plus days sales outstanding DSO minus days payable outstanding DPO. Let's apply this to Amazon's supply chain dominance.
Okay.
Amazon operates with a cash conversion cycle of negative 40 days.
A negative 40-day cycle. Functionally, that means Amazon gets paid for its products 40 days before it actually pays the costs associated with those products. It operates entirely on other people's capital.
Let's break down the mechanics. Look at DSO, days sales outstanding. How long does it take Amazon to collect cash from a customer? Roughly 26 days. The retail e-commerce side is nearly instantaneous due to credit card processing, blended with slightly longer 30-day invoice terms for their enterprise AWS clients. They collect capital extremely fast.
Now look at the leverage on the other side. DPO, days payable. Outstanding.
Yeah.
How long does Amazon take to pay the third-party merchants, the server manufacturers, the logistics partners?
111 days.
111 days. I buy a $200 office chair on Amazon. My credit card is billed immediately. Amazon has the cash. The small business manufacturer in Shenzhen who built a chair doesn't see a dime of that money for nearly 4 months.
Amazon dictates the terms of survival. Suppliers have absolutely no alternative distribution channel with equivalent volume, so they are forced to accept these draconian payment terms.
Right.
Amazon holds the cash, the supplier holds an IOU.
This massive disparity creates a float. For those 111 days, Amazon is sitting on tens of billions of dollars of external capital. It is an enormous, legally binding, interest-free loan from the global supply chain.
And this float is the secret engine of their empire. They take that interest-free retail cash pool and deploy it to fund the massive CapEx requirements of AWS and their AI infrastructure.
They organically fund their high-tech, high-margin future using the brutal mechanics of their low-margin retail present.
Exactly. Compare that structural dominance to Microsoft.
Okay, what's Microsoft?
Microsoft's CCC is negative 22 days. Highly efficient, but driven by entirely different mechanics. Their DIO, days inventory outstanding, is virtually zero, around 5.85 days.
Because they don't warehouse physical goods.
Yeah.
They distribute enterprise SaaS software licenses digitally.
Exactly. But their collection cycle, their DSO, is significantly longer, stretching to 69 days.
Because they sell massive multi-million-dollar contracts to Fortune 500 corporations and federal governments. Those entities operate on rigid 60 to 90-day invoice cycles. Microsoft has to wait for the corporate bureaucracy to cut the check.
Right. And then there is Alphabet, Google. Google is the structural outlier. Their CCC is actually positive 30 days, meaning their own internal corporate cash is tied up in their daily operations.
Wait, they sell digital advertising space? They have zero physical inventory, just like Microsoft. Why is their capital tied up?
Because their DPO, days payable outstanding, is incredibly short, only 27 days. A massive portion of Google's operational cost structure consists of traffic acquisition costs, or TAC, and they do not have the leverage to delay these payments. They must pay their partners strictly on time.
Okay, before we dive into TAC, I have to push back on the premise of the cash conversion cycle as the ultimate moat.
Sure, go ahead.
If utilizing a massive retail float is the secret code to funding a multi-trillion-dollar tech monopoly, why didn't Walmart invent AWS?
That is a great question.
Right. Walmart is the undisputed king of supply chain leverage. They have the scale, they have the float. Why are they just a grocery store while Amazon owns the cloud?
It comes down to the genetic code of the corporate structure and the rigid expectations of the shareholder base.
What do you mean?
Walmart was engineered in a different era, optimized for supply chain margin extraction and relentless dividend stability. Their shareholder base consists of pension funds, endowments, and retirees.
They demand a cash yield. They expect that quarterly dividend check to clear without fail.
If the CEO of Walmart held an earnings call tomorrow and announced, "We are suspending the dividend and halting all share buybacks for the next decade to sink $100 billion into speculative data centers to compete in cloud computing," the stock would gap down 50% the next morning.
The institutional shareholders would absolutely revolt and replace the board.
But Amazon's shareholders...
Right. Amazon's shareholders were systematically conditioned by Jeff Bezos from the 1997 IPO letter onward.
Exactly. He trained his investor base to accept zero dividends, zero share repurchases, and razor-thin retail profit margins under the explicit agreement that every available dollar afloat would be aggressively reinvested into massive asymmetric future growth.
Wow. Walmart is mechanically trapped optimizing for present cash distribution. Amazon is structurally liberated to optimize for future monopoly.
It's corporate DNA. Now let's pivot back to Google and this concept of TAC, traffic acquisition costs. You mentioned they are forced to pay these bills on a rigid 27-day cycle. What exactly is this cost?
TAC is the multi-billion-dollar toll Google pays to maintain its monopoly over the Internet's front door. It is the capital they deploy to ensure Google search is the default engine on third-party devices and browsers.
And the most glaring example is their arrangement with Apple.
Yeah, current estimates suggest Google pays Apple approximately $20 billion in pure cash every single year.
$20 billion a year, just to ensure that when you open the Safari browser on your iPhone and type a question, it defaults to Google instead of Bing.
Honestly, from a business perspective, that sounds like extortion. Google Search is arguably the best product on Earth. If they just stopped paying the $20 billion and Apple switched the default to Bing, wouldn't 95% of users just immediately download the Chrome app or manually navigate to google.com?
You'd think so, but no.
Why pay a ransom when your product is vastly superior?
Because Google's quantitative analysts have run the models, and they understand the terrifying power of the default effect.
The default effect.
Behavioral economics proves that human beings are fundamentally inert. If Apple switches the default to Bing, a massive, unacceptably large percentage of the billion-plus iOS user base will simply use Bing out of pure convenience.
And losing that specific demographic of traffic isn't just about losing ad revenue, it's about losing the data.
Exactly. Search engines are not static algorithms. They are organic machines that require constant data ingestion to remain relevant. Every single time a user queries a term, clicks a link, or bounces back to the search page, they are unknowingly providing training data that refines the algorithm.
And iPhone users represent the most lucrative, high-volume search demographic on the planet.
If Bing suddenly captures a massive share of that iOS search volume, Bing's algorithm will accelerate and improve exponentially due to the data influx. Meanwhile, Google's algorithm will begin to stagnate and degrade because it is starved of that critical feedback loop.
The $20 billion TAC payment isn't a marketing expense. It is a defensive breathing tax. Google pays it to keep the oxygen flowing to their algorithm and to simultaneously suffocate their competitors.
Spot on.
Speaking of Google's massive cash outflows, this leads into a corporate finance paradox that always trips up analysts. Google is sitting on a fortress balance sheet. They have roughly $126.8 billion in cash and short-term investments just sitting there. Yet, if you look at their financing activities, they frequently issue corporate debt to build these new AI data centers. Why would a company with $100 billion in the bank borrow money from Wall Street and agree to pay interest?
It is the ultimate expression of the tax shield and capital arbitrage. It feels deeply counterintuitive to retail logic, but borrowing money is mathematically cheaper for Google than spending its own cash.
Break down the CFA mechanics on that arbitrage for me.
Let's start with the tax shield. We discussed this when calculating FCFF. The interest payments a corporation makes on its debt are legally tax-deductible expenses. If Google issues $10 million in corporate bonds at a nominal interest rate of 4.5%, the actual effective cost of that capital after applying the tax deduction might drop to roughly 3.5%.
So the government is essentially subsidizing their borrowing costs.
Exactly. Now look at the asset side of the ledger. That $126.8 billion is not sitting in a checking account yielding zero.
Of course not.
Corporate treasuries deploy that capital into short-term UST bills, commercial paper, and money market funds. In the current macroeconomic environment, that massive cash pile is generating a safe yield of around 5%.
The arbitrage is incredibly clear. They are borrowing billions of dollars at an effective after-tax rate of 3.5%, while their existing cash pile is simultaneously compounding at 5%. They are literally printing a risk-free 1.5% spread on borrowed money.
It's institutional yield farming. But beyond the yield spread, there is a strict accounting advantage. Issuing debt protects the integrity of the income statement.
Because borrowing cash is not classified as revenue.
Correct. When Google issues a bond, the cash inflow hits the balance sheet as a liquid asset, and the bond hits the liabilities column. On the cash flow statement, the influx is recorded under cash flow from financing CFF.
So it bypasses the income statement entirely. It doesn't touch net profit, and it doesn't trigger any tax liabilities regarding the repatriation of overseas cash reserves.
It is pure corporate finance wizardry. They fund their hypergrowth without liquidating their yield-generating assets and without triggering tax events.
Now, issuing corporate bonds is one way to fund an empire without burning through your cash reserves. But the tech sector relies heavily on a second, far more controversial method: printing shares. Stock-based compensation.
Ah, SBC. This is highly relevant to you, actually, who receives restricted stock units as part of your Google compensation package. But we have to look at how SBC mechanically impacts you from the perspective of an equity investor holding Amazon.
It operates as a double-edged sword, right?
Very much so.
On the positive side, utilizing SBC is phenomenally accretive to corporate liquidity. By compensating top-tier AI engineers with freshly printed stock certificates instead of massive cash salaries, the company preserves billions of dollars in actual cash.
Right.
That cash stays safely inside the corporate treasury, dramatically boosting operating cash flow, which they can then deploy into CapEx without taking on dangerous levels of debt.
It is an incredible cash preservation tool. But the negative edge of the sword is severe structural dilution. Every single time the board authorizes the printing of new shares to hand to an employee, the total outstanding share count expands. The corporate pie is being sliced into increasingly thinner slivers. Your fractional ownership percentage of the enterprise mathematically shrinks.
Which naturally leads to the ultimate valuation question. If the company is actively printing shares and diluting the equity pool, why doesn't the stock price instantly crash the moment those RSU grants are announced? If supply is increasing, price should fall.
Because the institutional market is hyper-efficient and forward-looking, Wall Street does not value a company based on the basic earnings per share, utilizing the current outstanding share count. They exclusively use diluted EPS.
So the analysts run the valuation models, assuming that every single unvested employee stock option, every restricted stock unit, and every convertible bond has already been exercised and converted into equity.
Exactly. The future dilution is already fully priced into the current stock quote. The market accepts the reality of the expanding pie. However, institutional shareholders will only tolerate this aggressive dilution under one strict, non-negotiable condition.
Absolute, relentless net income growth.
Yes. The growth rate has to outpace the printing press. If your ownership slice shrinks from 1% of the pie down to 0.5% of the pie, but the total fundamental value of the pie triples in size, your smaller slice is still worth significantly more absolute capital.
Growth acts as a cloaking device for dilution.
Exactly. Or mature tech companies deploy an alternative mechanism to hide the dilution: aggressive share repurchase programs.
Like Apple. Apple is the master of this.
Oh, without a doubt.
They issue massive SBC packages to retain talent, but they simultaneously deploy their monumental free cash flow to buy back equity on the open market and permanently retire the shares.
They use cash to vacuum up the dilution, ensuring the total outstanding share count actually deflates over time.
So that covers the hidden structural tax of SBC. Let's tackle the other major mechanic that routinely trips up retail investors and impacts your portfolio: dividends. Specifically, the mechanical reality of the ex-dividend date.
This is a critical concept for a CFA candidate to master because it dispels a very persistent retail myth. Retail investors often assume that a stock price dropping on the morning of an ex-dividend date is caused by investors selling off their shares after capturing the payout.
Which is completely false. The price drop is not driven by selling pressure. It is a mechanical adjustment enforced directly by the stock exchange, driven entirely by the no arbitrage principle.
The market structure cannot allow free money to exist. Let's utilize Microsoft as the model. Assume Microsoft is trading at exactly $400 per share, and the board declares a $1 special dividend. If you purchase the equity the day before the ex-dividend date, you secure the legal right to receive that $1 cash payout.
But on the morning of the ex-dividend date, the stock transitions. It begins trading without the right to that specific $1 payout attached to it.
Right. And if the exchange allowed the stock to simply open at $400 on the morning of the ex-dividend date, they would invite a catastrophic, risk-free arbitrage loop.
How?
High-frequency algorithms would aggressively buy billions of dollars of the stock the day before at $400, legally capture the $1 dividend, and then instantly dump the stock the following morning at $400. They would extract billions in free cash with zero market risk.
And the market mechanics physically prevent this from occurring. When Microsoft eventually distributes that $1 dividend, $1 of actual book value tangible cash permanently exits the company's corporate treasury. The total value of the enterprise has mathematically decreased.
Therefore, the market value must be forcefully reconciled with the new book value. Before the opening bell even rings on the ex-dividend date, the exchange physically adjusts the previous day's closing price down by the exact, precise amount of the dividend distribution.
The stock is artificially forced to open at $399.
It is a zero-sum mechanism. A dividend does not create wealth. It simply relocates it from the corporate balance sheet to your personal brokerage account.
It is wealth realization, not wealth creation. And for you, working in tech and sitting in a punitive tax bracket, that realization is actively detrimental. That $1 mechanical transfer triggers an immediate taxable event. You are forced to pay dividend taxes on a payout that did not actually increase your total net worth by a single cent.
Which provides the ultimate fundamental justification for Amazon's historical refusal to issue a dividend. By retaining the cash, Amazon is telling its shareholders, leave the capital inside our treasury. We will aggressively reinvest it into high-return AI infrastructure without triggering a taxable event for you, compounding the internal value of the equity rather than forcing you to bleed capital to the IRS.
It is the most tax-efficient structure possible for a long-term compounder.
Absolutely.
We have covered an immense amount of structural, mechanical, and fundamental ground today. We have stripped away the retail noise and looked at the actual plumbing of the market. Let's synthesize all these disparate threads back into a concrete battle plan for you. Let's finalize the strategy.
You're holding 200 shares of Amazon. Your cost basis is heavily underwater at $227. The current market price is hovering dangerously around $210.
The execution summary breaks down into 3 distinct pillars. Pillar 1, technical and psychological reality. Your position is resting just above a massive, historically dense volume sponge. That high volume node between $195 and $202 lot represents heavy institutional accumulation.
Right, that $200 round number is a profound psychological floor built on the confluence of regretful buyers and desperate short sellers.
Pillar 2, fundamental valuation. You must discard the distorted PE ratio. When you analyze Amazon through the CFA lens of operating cash flow, utilizing the indirect method to strip out the $200 billion capex depreciation shield, Amazon reveals itself as an absolute cash flow leviathan.
Trading at a 16.1x POCF multiple, it is severely discounted relative to its peers, suppressed purely by market anxiety over the duration of the AI infrastructure cycle.
Pillar 3, risk management mechanics. You must avoid the retail traps. Do not implement hard stop-loss orders that expose your position to violent earnings gap whipsaws and liquidity vacuums.
And do not purchase protective put options that will immediately trigger the IRS straddle rule and completely obliterate your progress toward long-term capital gains tax status.
The tactical maneuver is patience combined with premium extraction. If the macroeconomic pressure forces Amazon down to that $200 level, and the retail panic causes implied volatility to explode into the 90th percentile, you do not capitulate.
You operate as the liquidity provider. You sell cash-secured puts at the $200 strike to capture the bloated IV premium, allowing you to either subsidize your existing losses or acquire your desired additional shares at a steep, subsidized discount.
It is a long-term portfolio strategy built on rigorous fundamental cash flow analysis, but executed with surgical precision, utilizing the technical mechanics of market panic.
It separates the analysts from the gamblers.
But before we officially sign off, I want to leave you with one final, deeply provocative concept, something to factor into your models as you monitor the tape this week.
We have discussed at length how Amazon and Microsoft are currently incinerating hundreds of billions of dollars in capex to build the global AI infrastructure. This unprecedented spending cycle is absolutely crushing their current free cash flow to the firm.
The market is punishing them for the sheer scale of the expenditure.
But extrapolate this timeline 5 years into the future. When these colossal data centers are finally fully operational, when the global AI grid is established, and this historically massive capex cycle finally cools off and normalizes, what happens to the underlying math?
What happens to that staggering $139.5 billion in operating cash flow when it is no longer being entirely consumed by infrastructure costs?
Will that resulting unprecedented tidal wave of retained free cash flow force these growth-obsessed tech behemoths to transform? Will they become the greatest cash-gushing dividend value stocks in the history of human commerce?
Or is the fundamental premise flawed? Is the AI hardware arms race actually a perpetual black hole? A never-ending cycle of silicon obsolescence where the infrastructure requires constant trillion-dollar upgrades and the promised hyper-returns never actually materialize on the bottom line.
That structural uncertainty is the exact risk premium the market is violently attempting to price in today.
And deciphering that uncertainty is exactly why we dive into the muddy waters of the mechanics. Thank you so much for joining us on this deep dive. Keep trusting your fundamental models, keep analyzing the charts through the lens of human behavior and institutional liquidity, and we will see you next time.